Welcome to the course on accounting and financial management. So in this session, we will study the depreciation and its accounting. Now see, what do you mean by depreciation? Depreciation is reduction in the usable value of fixed asset due to the wear and tear over the period of time or due to the obsolescence. See, what is depreciation? Value of the asset decreases. For example, you purchased a car for rupees, say 10 lakh rupees, right? Over the period of time, the value of a car, say after 5 years, what will be the value? It may be the 6 lakh or 7 lakh. That means the value at which you have purchased will decrease over the period of time is simply nothing but the depreciation. It is a depreciation. Okay. Now see why it is happening. See, it is due to the wear and tear because you are using it over the period of time and due to the obsolescence. Obsolescence means what? The new model come into picture. For example, you purchased the Nexon car, say in 2015. Now the new model came into picture. So why the people will buy the old model? That's called as obsolescence. Okay, it is a reduction in the value of asset. It decreases the value of asset in a gradual and continuous manner. It is not a sudden. It is gradually decreases the value called as the depreciation. The extent of depreciation is charged to profit and loss account. So whenever we talk about the depreciation, that must be deal with the profit and loss account of that particular firm. It is a part of the operating cost. Depreciation is a part of the operating cost. Okay, so that we will see technically in detail. Now in the book of account, when we talk about the accounting, depreciation is the we have treated as an expense. What is depreciation? It is the expenses. Always remember, depreciation we will treat as an expenses. And in the beginning, we learned expense is what? It is a nominal account. It is the nominal account in accounting. That's why we will debit the nominal account. Whenever expenses we are debiting, whenever the benefit we are crediting, right? So expenses are debited. We are saying depreciation is the expense, so we should debit the depreciation. Okay. Now see what are the reason for the depreciation? First is the wear and tear. Due to the actual use, we are using it, so wear and tear. Next is the efflux of time. What is efflux of time? See, reduction in the value of asset over the period of time when it is not used. For example, you purchased a car in say 2015 and you do not use that car, right? That means very less you have used or not used. So in 2016, what will be the value? Obviously, value will decrease. People will not worry whether you have used or not. It is first hand car, it is now second hand car. So that's why obviously the value will decrease. So whether you use or not use, obviously value will decrease over the period of time. Next is the obsolescence. Obsolescence means simply new technology makes the old asset outdated. For example, you purchase mobile phone. So latest model will come into picture in the market. Obviously the value of old will decrease. Next is the accident or the natural disaster happen with the say asset. For example, you are having some building, that building collapses in the say the natural disaster like a heavy rain. In that case the value will decrease. Fall in the market price, if there is general decrease in the market price itself, it will be the result for the depreciation. It will be the cause for the depreciation. So what are the reasons? Simply wear and tear. Efflux of time means over the period of time. Obsolescence means new technology. Accidents or the fall in general prices, that is market price. Next, what is the need for depreciation? Why we need it? Simply to get correct profit. To know the correct profit, after adjusting the depreciation, we will get the correct profit. To show the correct financial position, that is what? To reflect the true financial position, we use the depreciation. To make the provision for the replacement of asset, we use the depreciation, right? So using the depreciation, we can make provision for replacing that asset after some time. Okay, what is the reason for depreciation? What are the needs for depreciation? Simply to make the correct profit, to get correct financial position and have a provision for replacement of an asset. Now see, what are the factors which are responsible for the depreciation? See, for calculation of the depreciation, and the basic factor we consider the cost of the asset, the estimated number of year, that is what we can call it as a useful life of that asset, and lastly the residual or the scrap value of that asset. Okay, only three factor. At what cost you purchase? For example, you purchase at say 5 lakh rupees, right? What is useful life? Sorry, meaningly it will be used for 5 years of time, and scrap value means after 5 years the scrap value will be say 10,000, means it is the simply scrap value, or also called as the salvage value or the residual value. Okay, very simple. So based on that we can able to calculate the depreciation. Now see, accounting entry. How to do the accounting entry? See, in the book of account, depreciation is treated as the expenses, which is the non-cash expenses, right? Hence, we will treat it as a nominal account. So we know in nominal account what do we do? Whatever the expenses that we are debiting and whatever the benefit or the profit that we are crediting, right? So simply this is the nominal account. So what will be the entry? Depreciation account should be debited and asset account should be credited. Otherwise, depreciation account we will debit and the provision for the depreciation account we will credit. Okay. So in the exam they will ask you, in case of depreciation, which account should be debited? So always remember, in case of when we are doing the accounting book entry, at that time depreciation is always debited. Depreciation is always debited and asset is created. However, if we debit the depreciation, also if we are making the provision, then provision account can be created. Okay. Remember this, depreciation is always debited. D for depreciation, D for debit. Remember. Okay. Now depreciation calculation methods. How to calculate the depreciation? So in the examination, surely there will be one question based on this. Okay. So there are basically 4 to 5 methods. First is the straight line method. Second is the written down value method, WDV, also called as the declining balance method. Third is the unit of production method, and fourth is the sum of years digit method. And fifth, there is a double declining method, which is not a part of your syllabus. Still, we will take it because it is the, you will get better idea about the depreciation. Okay, out of that, I can say that the first three, there is accounting standard in India, AS10, and accounting standard, Indian accounting standard, INDS 16, says that they recognizes only 3 methods of the calculating depreciation. So most of the time, when you become the accountant or the CA, they will only use out of that 3. They either use a straight line method, the written down value method, or the unit of production method. So written down value method is also called the diminishing balance method or declining balance method. Okay. Now see, one by one we will discuss in detail. First is the straight line method. So this method of depreciation assumes that asset will lose the equal amount of value which is, see, name is indicating straight line. Straight line means what? Whatever depreciation is happening per year will be uniform. For example, 1000, 1000, 1000. Every year, value of asset will decrease by 1000. That is called as the straight line. You are declining the amount of asset. Okay. Now, see the formula. Which formula will you see? Annual depreciation is nothing but the cost, that is asset cost minus residual value divided with the useful life. Very simple. What is the cost? What is the purchase price minus what is the salvage value or the residual value divided with number of years. Okay, very simple formula. Now through example you will get a better idea. See, purchase price of a machinery is 20,000, estimated useful life of a machinery is a 5 year, and estimated residual value is 5,000. So what is given? Very simple. They have given that 20,000 is the price at which machinery is purchased. It will be used for 5 year, and after scrapping you will get 5,000. This is the meaning of that. Okay. What is the annual depreciation value on the asset as per the straight line method? So we have to find what will be the depreciation per year. Okay, they have given option 3,000, 4,000, 6,000, 5,000. Now see, we have the formula. What is formula? Asset cost minus residual value divided with the useful life of asset. Okay, what is the cost it has purchased at 20,000? So 20,000 minus the residual value, also called the salvage value or scrap value, is 5,000. So minus 5,000 divided with the number of years. It will be used for 5 years. Okay. So 20,000 minus 5,000 upon 5, it will be 15,000 divided by 5. It will be 3,000. So 3,000 is the depreciation per year. Okay. So what is the per year depreciation? Per year depreciation is 3,000. So 20,000 you purchase it, right? So and residual value is 5,000. So what will be the remaining value after 1 year, right? So that you have to calculate. So 20,000 is purchase minus 5,000 is the residual value. So 15,000 minus first year 3,000 is the depreciation, right? So 12,000 will be the book value at the end of first year. Okay. So here they have only asked what will be the annual depreciation. Annual depreciation will be 3,000. Very simple. Purchase price minus salvage value divided with the number of years, you will get the depreciation per year. Very simple. Now see another example. Purchase price of a machinery is 20,000. Estimated useful life of machinery is 5 year, and the residual value is 5,000. Okay. Now what they are asking, what is the annual depreciation value as per the straight line method, and what is the book value at the end of 4th year? They are asking book value at the end of 4 year. Okay. Now see, in the previously what we have learned how to calculate annual depreciation, the example is same. Right, first we will calculate the depreciation. What is depreciation? It is cost minus residual or salvage value divided with the number of years. What is the cost? 20,000 minus 15,000 is what? Is the minus 5,000 is what? Your residual or the salvage value divided with the number of years 5. Okay, you will get 3000. 3000 is what your annual depreciation. Just we calculated. Now see, we have to find book value at the end of year. Okay, what is the purchase price? Purchase price is 20,000. So at the end of first year, 20,000 minus 3,000, 17,000 will be your remaining value. At the second year, we will start with the remaining value. 17,000 minus 3,000, you will get 14,000. That will be the book value. At the third year, you will get 14,000 minus 3,000, 11,000 will be the book value. At the end of the fourth year, 11,000 minus 3,000, 8,000 will be the book value. So correct option which you have to mark is the 4,000. Always remember, it is very easy, right? Purchase price minus salvage value divided with the number of years. You will get the straight line method depreciation. Either is the annual depreciation. So for first year, simply subtract it from the purchase price. So 20,000 minus depreciation you will get for first year. Okay, whatever first year amount you are getting, subtract again depreciation you will get for second year. Again subtract depreciation you will get for third year. Very easy, right? Now, next example, see, annual depreciation calculated on asset using the straight line method with useful life is 8 year is 6250. If its salvage value is 10,000, what is the original cost? So, same problem is there. Here, they have given the annual depreciation, right? But they are asking original cost. So, very easy, right? This is the option they have given. Now, see how to solve this. See, we have the formula. What is depreciation? Annual depreciation is nothing but the cost of machinery or the simply purchase price minus the salvage value or the scrap value divided with the number of years. Okay, now this is with formula for depreciation. Now they are asking original cost. So price will be what? Depreciation multiply with number of years divided, and we have to simply add here yes is the salvage value. This will be the formula. Just rearrange the formula. Just rearrange the existing formula. Just now, right? So simply rearranging the formula, you will get asset cost is equal to depreciation into number of years plus residual value. Okay. So 6250 is what? The depreciation they have given, right? Multiply with the number of years is 8 plus what is the residual value they have given? 10,000. So simply 6250 into 8 is a 50,000 plus 10,000. You will get 60,000 as your answer. So option A is correct. Right? So in that way you have to go, right? Remember, I repeat what will be the formula. See, annual depreciation is nothing but is simply the purchase price or the cost plus you minus you have to do the salvage value divided with the number of years. So you have to find the cost or the purchase price. So P will be depreciation into number of years plus salvage value, right? Very simple. Now, written down value method WDV is also called as the decline balance method or also called as the diminishing balance method. So, in this method, the constant preparation rate per year is applied to the residual balance rather than the original cost. So it is very interesting. You see, written down value method is used mainly by the insurance company WDV. Okay. So here, what we are doing in the previously, we are applying the depreciation rate previously here to the initial purchase value. However, in case of declining balance, we are applying the residual value or the book value rather than the original cost. So, asset can be zero at any point of time in this method. Asset can't be zero because we are decreasing value by some percentage, but it will be not zero at any point of time. Okay, remember, it's very important that it cannot be zero using the WDV because asset will have some salvage value definitely. So, what is the formula? See, previous year's value multiply by percentage, you will get the simply written down value or depreciation. Right, very simple. What is depreciation? Simply previous year's value multiply with some percentage. What is the percentage? Depreciation rate. Or we can say simply the book value multiply with the depreciation rate, we will get the written down value. Okay. So through example, you will get a better idea. See, very easy. Company ABC acquire a machine that cost 10,000. The machine has expected life of 3 years. Suppose the depreciation rate for the machine is 10%. Calculate the depreciation need to be charged for each year. We have to find the depreciation. So what is given? So we have costed the purchase machine for 10,000. 3 years we will use it, and depreciation per year is 10,000. So very easy. See that see for first year what will be the depreciation? See, they have given directly 10% is the depreciation rate. So 10,000 is the purchase price. So 10,000. So 10,000 into 10%, what will be? It will be 1,000. So 1,000 will be the depreciation amount, right? So 10,000 is the cost. So for first year, 1,000 will be depreciation. So remaining will be 9,000 will be the year end value or say book value. At the end of second year, we will start with whatever the previous year's book value, right? So 9,000 is the beginning value. So 10% of 9,000 is 900. So 9,000 minus 900, remaining value will be 8100. What they have asked, the depreciation to be charged for each year. Okay, for third year C, the remaining value will be 8100. 10% of it is simply 810. So remaining value will be 8100 minus 810, that is 7290. So what they asked, the depreciation to be charged for each year. So for first year, we will charge 1000. For second year, we are charging 900. For third year, we are charging 8100. So such a easy is. Now they can ask any type of example. They will ask you the same problem and they will ask you what is the year end value at the end of 2. At the end of 2. So answer will be 8100. They can ask you what is the depreciation for the first year. So for first year depreciation will be 1000. They can ask you what is the depreciation at the end of third year. So for third year depreciation will be 810. They can ask you what is the book value or the year end remaining value at the end of third. Okay, so it will be 7290. So thing is very simple. See, date of depreciation is 10,000. So for first year, what will be the depreciation amount? 10,000 into 10%. So answer will be what? 1000 will be depreciation. For second year, what will be the new the remaining value? 1000, 10,000 minus 1000. So 9,000 will be the next year's value. Multiply it with the 10% again. So what is depreciation? 900. For third year, 9,000 minus 900, it will be 8100 will be the opening balance. Multiply with 10%, you will get 810. That will be third year depreciation. So and at the end of third year, what will be the remaining value? 8100 minus 810. That will be 7290. Okay. So it's such a simple is this. Okay. Remember, it is very, very important for exam point of view also. Okay. Now next is the unit of production method. So what happened actually? This method is usages based. See, this is the use based. For example, it is happening very common. See, you purchase a car, right? You purchase it for 10 lakh rupees. You didn't use, you rarely use that car. And after 1 year, the person who want to buy that car is asking for 5 lakh rupees. So you are saying, so I have not used the car. You are asking such a low price. So at that time, you will say that I will apply the unit of production method or usages method because I have very less user. So give me more price. So at that time, that method is useful. Okay, this is also called as the usage based method. The depreciation amount is based on the actual use of asset, not based on the time, right? You have purchased a VR when it is not important. It is important whether you have used or not. So this method is suited to those assets which depreciate in proportion to their use. In this method, the useful life is measured in terms of production output or number of units which an asset can produce during the lifetime. That means simply how much we have used that asset, right? So it is not commonly used method. It is not commonly used method. So what is formula? See, depreciation is nothing but the actual production done divided with the expected production multiply with the depreciable amount. Very simple. Otherwise, you can use another formula. Simply, you can use what? The usages done during that period upon usages during total life of this asset multiply with depreciable amount. Okay. So don't have to worry about this formula. When you go through the problem, you will get a better idea. See, a company ABC Limited purchases a machine. This machine has a can manufacture a 10 lakh unit, after which it have to be scrapped. Means what? Maximum capacity to produce the 10 lakh unit. The purchase price of this machine is 1 lakh rupees and scrap value is 10,000. Okay. During the first year, the machine has produced a 2 lakh unit. So depreciation amount we have to find in the first year. What will be the depreciation in the first year? Okay. Now see what is given. 10 lakh maximum that machine can produce. Out of that, 2 lakh they have produced in first year itself. Right. This is the 1 lakh is what? The scrap value or the residual value or the salvage value. And 10,000 is what? Is the scrap value. However, a machine has purchased for 1 lakh. Okay, sorry. 10 lakh is the maximum they can produce. 2 lakh is produced in first year itself. And 1,000 is the 1 lakh is the cost of machine and 10,000 is the scrap value. Okay, this is given data. Now we have formula, simple formula. What is the actual production done? Right? Then divide it with the total expected production and multiply simply the depreciation or depreciable amount. Multiply with simply the total depreciable amount. Okay, how to calculate the total depreciable amount? Simply the cost price minus salvage value, or the price minus the salvage value, you will get the depreciable amount. Okay, now see, actual production, what is given? 2 lakh. So 2 lakh divide it, so simply 2 lakh divided with what? How much can produce? 10 lakh. 10 lakh multiply with the depreciable amount. It is what? Simply 1 lakh minus 10,000. So amount will be here 90,000. So simply it 2 lakh upon 10 lakh, it will be 1 by 5 of what? 90,000. So 1 by 5 of 90,000, simply 18,000 will be your answer. So 18,000 is the depreciation for the first year. Got it? So in that way you have to apply. Very simple. This is the most basic simple thing. So in the previously in the first method, straight line method, what we are doing? Cost price minus residual value dividing we are with the number of years. So here what we are doing? Simply we are cost price minus residual value, simply we are multiplying it here the actual production upon the expected production. Okay, this is the changes. You compare, you can easily remember. Okay, now next is the sum of years digit method. So in this method, we have to calculate the depreciation amount by using the sum of a digit of years over the asset can be used. Means, for example, see, if asset is used for 3 years, then we will add 3 plus 2 plus 1. Well, okay, you will get here 6. Okay, so in that way you have to do the calculation. So this is the accelerated depreciation. Means what? In the beginning, there will be more reduction, more depreciation we are allowing, so that more depreciation in the beginning means less taxes we have to pay, right? So it allowed more deduction in the starting life of an asset, so that tax benefit can be get in the early years. So very simple. So how to do? See, through problem you will get again the better idea. Sum of years digit method. Now see, useful life an asset is 10 years. Sorry, useful life of asset is 5 years. The value of asset is 10,000. Salvage value is 500. What is the amount of depreciation after first year, second year, third year and fourth year? Using the sum of digit method. Using the sum of digit method. Now see what is given. See, for 5 years, so number of years will be 5. Value is 10,000. Value of asset is 10,000. Salvage value, scrap value is 500. And we have to find the depreciation for each year, or 1, 2, 3, 4 year, using the sum of digit method. Now see, what is useful life? 5 year. So in case of whatever number of years they have given, just decrease by 1 by 1. So for a 5 year, we will add 5 plus 4 plus 3 plus 2 plus 1. So just sum it. 5 plus 4, 9. 9 plus 1, 10 plus 5. It will be 15. So if they are asking for 3 year, what will be then? 3 plus 2 plus 1. It will be 6. In that way you have to calculate. Very simple. Now what is book value? Book value we have to calculate, or we can say the depreciable amount. Okay, 10,000 is the purchase price, 500 is the salvage value. So 10,000 minus 500. So depreciable base we will have as a 9500. Okay, now we have to calculate depreciation for first year. So it is, see what I told you, it calculate the depreciation more in the beginning year. Means we have to take more depreciation for the early years and less for the next year. Okay, so for a first year, what will be the rate of depreciation? Simply see 1, 2, 3, 4, 5 and sum is 5. So in that we remember, for first year we will take 5. 5 upon total is sum, so total sum is 15. For next year 4 upon 15. For next year 3 upon 15. For next year 2 upon 15. So this is for first year, this is for second year, this is for third year, this is for fourth year. So in that way you have to write them, right? This is the percentage of depreciation for respective year. For first year 5 by 4 means more. For second year 4 by 3 means less than the first, right? So in that way you have to write. Okay, so see the solution part. For first year for a 5, 4, 3, 2, 1. This is the number of year for which we are calculating the depreciation. Okay, so total 5 years are there. Okay, now see, sum of year is a 15 for each year. Okay, now percentage of depreciation. So here it must be for first year, for second year, for third year, for fourth year. This is for fifth year. Okay, now for first year, what will the depreciation rate? 5 by 15. For second year 4 by 15. For third year 3 by 15 and so on. Okay, now this is the rate of a depreciation, right? 4 by 15. Okay, you may multiply by it 100, no problem. Okay, now what is depreciable base? That is purchase price minus salvage value. So 1/3 of a 9500, it will be 3166.67. This is the depreciable amount for first year. For second year 4 by 15 into again the same it will be 2533.33. For third year, 3 by 15 into 9500. For a fourth year, 2 by 15, and for next year it will be 1 by 15. Okay, so when you add all, you will get again total 9500, which must be equal to your depreciable base and depreciable amount you see. Okay, that means your calculation is correct. Okay, so I repeat what you have to follow. Okay, here it must be 1 2 3 4 5. Okay, here it must be 1 2 3 4 5. Okay, now see, it is very simple. Simply you have to do the sum of years. Okay, 15 for a first year. It should be what? For a first year. Sorry. For first year, it will be 5 by 15. It will be 5 by 15. For next year, it will be 4 by 15. For a third year, it will be next. For next year, it will be 2 by. That means you have to decrease it by 1 by 1. That means more depreciation in the early years. Okay. Simply multiply that depreciation rate by depreciable amount. You will get the depreciation for that particular year. If you add all that depreciation, it must be equal to the depreciable amount. Okay, then you can see here your calculation is correct. Okay, now double declining method. This is not given in your book. Okay, but it is one of the important method. You just go through it. See, in case of double declining balance method, this is nothing but the accelerated depreciation. Means depreciation will increase over the period of time. So here asset value is depreciated at twice the rate of a straight line method. Means whatever the straight line method, we will use just double of depreciation in that method. Very simple. So when the depreciation charge dips below the amount of depreciation in straight line method, at that time we will again start using the straight line method. So we are having very simple criteria here. What is the straight line method rate? 20%. Okay, so we will use here the 40%, which is double of the straight line method. And in that case, if depreciation amount gets reduced using the double declining, then we will again move back to the straight line method. Okay, so through example you will get better idea. See, towards the end of the depreciation period, the higher amount of the two method is to be considered. Okay, now see the through example you will get idea. See, computer is purchased for 5,000. Estimated residual value, salvage value is 200, and the useful life of that computer is 3 years. We have to calculate the depreciation using the double declining method. Now see what they are given. As per the straight line method, what will be the depreciation? Simply 5,000 minus 200. 5,000 minus 200 upon number of years 3. So it will be 4800 upon 3. It will be 1600. 1600 will be the depreciation as per the straight line method. So what will be the book value or the depreciable amount? 5,000 purchase price minus your salvage value. So 4800 is what your book value, or you can say it is the depreciable amount. Okay, or depreciable base we can call it. So percentage of depreciation in a straight line method will be what? Simply we have to calculate the percentage. Okay, so 1600 is the depreciation for 4800, right? Multiply with 100, so you will get, say simply it is 1 by 3, or simply you can say 33%, 33.33%. Okay, just double it. So either you can take 1 by 3 for a simplicity, or you can take 33.33. We have to double it simply. Okay, so you can take 2 by 3 for ease of calculation, or you can simply take 66.66. It is your choice, right? 1 by 3 I have taken for a simplicity. Doubling it, simply 2 by 3. Or if you have confusion, you can take simply 33% for a straight line. You just double it, you will get 66.66%. Okay. Now see, for first year, depreciable base is 4800, and rate we have calculated. What is it? 2 by 3, that is 66%. So 66.66% of 4800, you will get 3200. Just multiply, right? This is very easy, basic calculation, right? So 2/3 of 4800 is what? 3200. So what will be the residual value? 4800 minus 3200, you will get 1600. For next year, you have to again start with the residual value. So 2/3 of residual value is what? 1066. So 2/3, that is what? The 6.66% is of 1600 is 1600, which is less than 1600, the amount of depreciation by straight line method. So things at the moment you find the amount is less than the straight line method, you should use what? You should use the straight line method again. So here amount you have to use the straight line given by straight line method. So 1600 minus 1600, so residual value at the end of second year will be 0. So in that way, you have to calculate using the double line decline method. So only point is that, see, simple fund is there. What is the percentage in straight line method? You have to just double it for doubling declining method and use that percentage. Whenever you find that depreciation using the double decline method falls below the straight line method, you have to use again straight line method. Okay. Now see one small concept, sinking fund. What is sinking fund? See, simply fund collected for repaying the debt is called as the sinking fund. Sinking means what? It will be synced. For example, you collected the money. For example, you collected 5 lakh rupees, right? And you are collecting that money so that in future you have to pay 10 lakh rupees. Okay, so that fund will be synced into the debt. So that is called sinking fund. So in future you will be valued to repay the debt. So this is the technique for depreciation an asset while generating the enough money to replace it at the end of the future life or at the end of useful life. Now see, sinking fund method for replacement of fixed asset means whatever asset we are having, that will be useful for only say 5 years. Okay, what after 5 years? So whatever the profit we are generating in that 5 year, we will accumulate this so that we will have some amount and that will be used to replace that asset after 5 year. Got it? Very simple. So a company set aside money annually to replace asset after its useful life is called sinking fund for replacement of fixed asset. The amount which set aside will earn the interest, ensuring funds are available when the replacement is needed. Okay. Now next is the interesting concept, amortization of intangible asset. What is amortization of debt? Amortization of loan means how you are doing the repayment and when it will decrease your loan, it will reach to zero. It is amortization means how you are it is simply the repayment. Okay. Amortization of intangible asset is what? See, amortization in Indian accounting standard IND AS 38, which deal with the intangible asset, described as amortization is the systematic allocation of a depreciable amount of intangible asset like a trademark, goodwill, etc. Means what? See, we are doing the depreciation for the tangible asset. In the previously we learned either you can use straight line method, written down value method, right, or the unit of digit method. You can use it for tangible asset, but for intangible asset, what you do? You have to use the amortization. Okay. So calculation is very much similar with the depreciation which we learned recently. Okay. So simply remember, for tangible asset we are using the depreciation and for intangible asset we are using the amortization. Okay. Only that two things you remember. Okay. So friends, thank you. You can subscribe us on the YouTube, join our Telegram channel, and this is the Android application available at the Play Store. You can download this. This is our helpline number for WhatsApp. Thank you.